Opinion: the Fed doesn't have a choice anymore. Get ready for a recession. To numerous financial specialists and experts, the US economy has addressed a mystery this year. From one viewpoint, gross domestic product development has eased back essentially, and some contend even entered a downturn. Then again, by and large, business development has been a lot more grounded than typical. While gross domestic product declined at an annualized pace of 1.1% in the principal half of 2022, the US economy added 2.3 million positions over the most recent half year, undeniably more than in some other half-year time span in the 20 years preceding the pandemic. This tight labor market and the quick compensation development it has prodded is making expansion become more dug in. The buyer value file, which estimates a container of labor and products, was 8.3% year-over-year in August. That is lower than the 40-year high of 9.1% in June, yet at the same time agonizingly high. To address it, the central bank is probably going to drive the economy into a downturn in 2023, crushing continued job growth. Why has employment growth remained so strong? First, the US economy is hanging on better compared to many anticipated. The Atlanta took care of's GDP now gauge for genuine gross domestic product development in the second from last quarter of 2022 is 2.3%, recommending that while the economy is currently developing substantially more leisurely than it did last year, we are as yet not in a downturn. At the point when the interest for labor and products reinforces, so does the interest for laborers delivering these labor and products. Second, regardless of the easing back of the economy and the developing feelings of dread of downturn, cutbacks are still generally low. Beginning cases for joblessness protection, a marker profoundly related with cutbacks, were 219,000 for the week finished October 1, higher than the week earlier, yet at the same time perhaps of the least bruising in late many years. Following quite a while of progressively horrendous work deficiencies, numerous businesses are hesitant to fundamentally decrease the quantity of laborers even as their organizations are easing back. That's because companies are worried that they will have trouble recruiting new workers when they start expanding again. Third, many industries are growing faster than normal because they are still recovering from the pandemic. Show and expo coordinators, vehicle rental organizations, nursing homes and kid daycare administrations, among others, are developing quick since they are still well beneath pre-pandemic work levels. Fourth, similarly as certain ventures are developing since they are as yet making up for lost time, others are encountering high development as they conform to another typical of more popularity. Interest for information handling and facilitating administrations, semiconductor fabricating, emotional wellness administrations, testing research centers, clinical hardware and drug producing is higher than before the pandemic. Also, almost certainly, these address underlying changes to purchasing behaviors that will keep request high. Fifth, during the pandemic, corporate investments in software and R&D reached unprecedented levels, which drove a rapid increase in new STEM jobs. Because these workers are especially well paid, they have had plenty of disposable income to spend on goods and services, which has supported job growth throughout the economy.